Good day, everyone. This is Stephen Martin. We are still assembling. I'm going to give our attendees about 30 seconds left, and we'll begin our webinar. Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. My name is Stephen Martin, and I lead Business Solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to members, and if you're not a member, please go to rmahq.org to explore all the things that we have to offer. May 5th through the 7th. It's really a great conference. The content is terrific, perfect for consumer credit professionals. Topics will be things like the pandemic, the economy, regulation, artificial intelligence, machine learning, cyber risk, consumer model and validation risks. The whole agenda is at our website, rmahq.org/GC SB, Global Credit and Small Business Risk. Today's webinar is the latest installment of our credit trends in commercial lending. It's a part of our risk analysis service, and it's presented by Tom Cronin and Jeremy Charlson from AFS. So like always, during the presentation, if you have a question for the speaker, you don't have to wait. Go ahead and submit that using the Q&A feature at the bottom of your Zoom screen. For those of you who are new, this is really a nice feature of this webinar, and we really encourage you to do it. And you returning attendees know the drill, and I look forward to your questions. And at this time, I'd like to turn it over to you, Tom Cronin from AFS, and thank everybody for joining us today.
Thanks, Stephen, and welcome to everyone joining us today. I want to make two comments before we get to the first quarter results. First of all, if you joined us last month, I wanted to thank you for completing the survey at the end of the webcast that Stephen will mention. We've implemented a number of suggestions from the January data survey, and we're going to add in a couple more today from the February data survey. And I just want to say that your suggestions are very helpful in making this webcast continue to meet your expectations. So please take the extra time and fill those out. Secondly, near the end of the February data webcast, I mentioned that the first chart I would create with the March data was the CRE performance trend chart. I wanted to see if the drop in the non-accruals we saw for February was the start of a trend or just a pause. So I did create that chart right off, and because of that, I'm going to switch the presentation order today. We're going to review CRE first and then examine C&I. Our data source is the Risk Analysis Service, or as we call it, RAS. We gather performance data from banks every month now, process and verify about $1 trillion in exposure and 875,000 loans, and then we return that data to each bank member via a workstation. With that workstation, member banks can then compare their data and results to their select peer groups by segments such as collateral, industry, geography, or deal size. Now we're going to move on to the CRE results, and a quick definition before we look at the charts. CRE loans are made where the primary repayment of the loan comes from renting or leasing the property. And these are often referred to as investor-owned properties. So as promised, we're starting our examination of the performance of the CRE portfolio with our CRE performance trend chart. On this chart, we are showing the 4 measures we use to see how loans are doing. Non-accruals are the red line. 30 to 59 days past due are the blue line. 60 to 89 days past due are the yellow line, and loans 90 plus days past due are the green line. And going left to right for any of these four measures, you see the dramatic recovery from the recession. For example, non-accruals had been 9.3% in late 2010. By March 2020, just at the beginning of the pandemic, the percent non-accruing had dropped to 0.28%. Since March 2020, all delinquencies have fluctuated considerably, reaching a combined high of 2.9% in April of 2020, falling back to 0.74 by September, and now for March 2021, it's climbed back above 1% to 1.05. And again, that's all three of those delinquency measures added together. And more than half of that 1.05 is for 90 days past due, 90 days plus past due. We're going to talk about that a little bit later on. Now, non-accruals began to deteriorate in May of 2020, and up until the last month had increased in 7 out of the 8 periods. February's percent was down, and we wanted to see if March's number would indicate a continuance of the improvement. And as you can see here, it does, although extremely slightly. For March 2021, the percent non-accruing came in at 1.18%, down ever so slightly from 1.2% for February. So let's look at the non-accruals again, this time by property type. And using exposure, we've pulled the non-accrual rates for the top 8 property types that you see across the top of the chart. And if you've joined us for any of our webcasts since September of 2020, you've heard us use the term K-shaped recovery, which basically means some segments are doing well after the initial shutdowns due to the COVID-19 virus, and some are not doing so well. Now, we usually apply that term to C&I, but you can see here it applies to CRE as well. The property type with the most notable change is lodging. At the end of May in 2020, the non-accrual level for lodging was 0.13%. Now, I'm going to say that again because it still blows me away. The end of May was 0.13%. And by the end of 2020, as you can see here, it had climbed to 8.2%, and it reached a high of 8.84% in January. Now, the March result is 8.65%, and that's improvement for the second month in a row. The other property types, as you can see here, have not been as impacted severely, but we can put those into 2 groups, what I'm calling a moderate impact and a limited impact. You can see the moderately impacted property types now hovering close to 1%. The orange, the green, the blue, and the yellow. And those are healthcare at 1.4, retail at 1.3, industrial right at 1, and mixed use at 0.8. The other 3 property types are what I'm calling limited impact. And those are down there at the bottom in the purple and the green again. Residential at 0.3, multifamily at 0.25, and perhaps most surprisingly, office at 0.21%. So let's backtrack a second to our first CRE chart and recall our discussion regarding the all-in delinquency levels. I'd mentioned that 90 plus days past due were a large percentage of this. In fact, 90 plus days past due are 0.61% of all days past due amount of 105, so greater than half. And usually, most banks have a policy, and I'm sure most of you on the line have this policy that says, if a loan is 90 plus days past due, automatically move it to non-accrual unless there are special circumstances. And some of these special circumstances could be the property's in the process of being sold, it's in the process of being refinanced by a different lender and getting the documents completed is behind, or the bank feels a return to good financial performance is imminent. But the regulatory agencies like the FDIC and the Federal Reserve publish statistics that combine the 90 plus and the non-accruals, basically ignoring these special circumstances. And that's what we did on this chart. So this is our non-current chart. So non-current is 90 days past due plus non-accruing. And it shows here that lodging now is above 12%. Healthcare, industrial, and retail move up to near 2%. And the other major property types are at or below 1%. But clearly, lodging properties have been most impacted the most by the closures and curtailments imposed by state governments due to COVID-19. Now let's move on to credit quality. And with credit quality, we're talking about risk ratings, borrower risk ratings, or property risk ratings in this case. So when a bank joins RAS, we take that bank's borrower risk ratings or property risk ratings, again for CRE, and map them into the RMA 10-point scale. 1 through 6 on that scale represents a pass loan. 7 through 10 represents criticized loans as follows. 7 is special mention, shown here in the blue. 8 is substandard, the yellow. 9 is doubtful, which is the green. And 10, if you can see it right above the 11, is a loss. And on this chart, we're showing the trend in each of these criticized segments. And when we started RAS CRE, the overall percent criticized was north of 30%. It's improved quite dramatically, and we reached a service low 1 year ago today. March 2020, percent criticized was 2.11%. By July, however, by July of 2020, the percent criticized had climbed to 8.9%. And since July, the rate has fluctuated, up 5 basis points for March. It now sits at 8.28%, and it's somewhat stalled out since the initial run-up last year after the virus began to impact property types. Now, we've been using this chart, which was designed by Zions Bank, for a number of months. It's a very interesting combination of performance and credit quality to give us an idea here by property type of how loans are performing now, which is the red or the non-accrual, and how they are forecasted to perform, the special mention in blue and the classified in yellow. And once again, we're seeing 3 tiers or levels, as I call them, of impact. Lodging is far and away the worst performer, both current and projected. Pardon me. Even the current non-accrual percentage for lodging, that's the red, is higher than the combined levels of any other property type. The 3 property types that follow this that are above 5% are healthcare, retail, and office. And the other 4 are below 5%, those being mixed use, multifamily, industrial, and you can see just a little bit of residential. So staying with the same chart design, we wanted to provide a little extra detail on lodging since that obviously has been the most impacted property type. So again, we're providing the non-accrual, special mention, and classified values. And let's start here. We're doing this by region, lodging by region. And this would be where the hotel is actually located. And we're going to start with non-accruals, which is the red sectors. And one quick note, in CRE, location is based on the address of the property. Pardon me. The non-accrual sectors are highest in the Northeast, with the percent non-accruing at 31.5%. And within the Northeast, it's highest for lodges or hotels in the New York and Massachusetts area. Next highest non-accrual is the Eastern Midwest at 13.8%, and then the Southwest at 8.7%. Non-accrual levels for the other regions are relatively low, especially when you compare them to the 31% of the Northeast. So let's switch now to the blue and yellow for a forecast of what loans might end up as troubled. If you look at the South, the middle column, currently it has one of the lowest non-accrual percentages, but the forecast is not promising. 43% of the lodging loans in the South is labeled as special mention. And coupled with the 9% classified rate, more than half of the lodging loans in the South are predicted to experience some kind of trouble. We see a similar story, though not as severe, in the West and the Western Midwest. Currently in the West, the non-accrual level there is very small, but the forecast, again, the special mention in classified, is for almost 40% of the loans to experience a deterioration in performance. So obviously not a very pretty picture, almost regardless of where you are in the country. We're going to conclude our analysis of CRE with two charts on growth. Here we're looking at the loan outstandings for every bank quarter versus quarter. The top of the line for each comparative quarter represents the bank with the highest change. The bottom of the line represents the bank with the least amount of change, which here happen to be all negative, so decline in balances. And the box you see in the middle is the average. So for you statisticians, we did examine the medians for each time period, and there was very little difference, average versus median. So here we're showing average. And if you focus on the averages, you can see there's been very little growth since this time last year. In fact, only the June versus September timeframe saw an average increase in balances. This is off dramatically from March 2020, where we had 17% annualized growth. Now here's a little different view for CRE growth. Once again, we've pulled data for the 8 largest property types. And this time we're looking at loans that were newly made in the first quarter of 2021. The size of the box for each property type is indicative of the amount of new loans. 33% of new loans were made for residential properties, the big box on the left-hand side. Office was next at 23% in the green. And then retail, multifamily, and industrial all came in right around 10%. And just as a note, new loans for lodging represented just 1% of the new CRE loan volume. So we're going to examine the CRE portfolio on the next pages. By way of definition, C&I loan, we're going to examine the C&I portfolio now. And by way of definition, C&I are business purpose loans made to companies with annual sales north of $1 million. These loans are manually underwritten and also manually risk rated. And loans secured by owner-occupied properties are here in C&I. And we want to start off this section with a poll. So here's our poll. We've had some discussion about deferred loans and are they still around? So we want to see if you could tell us what percent of your commercial loans are still preferred. Less than 1%, 1 to 3, 3 to 5, and greater than 5. And we'll give you 30 seconds, 30 seconds or so to fill this out. Maybe another 5 seconds. Jen, can you close that out? Okay. So well over half of you basically have the deferred loans have gone away, but there's still about another half that are in a 1 to 3, 3 to 5% range. So we thank you for this. So we'll close this. And we'll move on to the C&I results. So the same thing we did with CRE, we're going to start with the C&I loan performance trend chart. Again, we're looking at non-accruals in the red, 30 to 59 days past due in the blue, 60 to 89 days of the yellow, and 90 plus days past due is the green. And this goes all the way back to 2003, the beginning of RAS, goes through the 08-09 recession. You can see the buildup there, particularly for non-accruals. The 2016 energy crisis, another rise in non-accruals. And then with the pandemic disruption of 2021 and 2020 and 2021, you see the other increase. And unlike what we saw with CRE, 90 plus days delinquents barely registers on this chart. And 60 to 89 days peaked at 0.34 in May, but now are at 0.10%. So let's focus on, if we can, on the short-term delinquencies and the non-accruals, which are the blue line and the red line. Now at 1.33%, we saw a service level high for short-term delinquencies for April 2020. Again, the blue line. Since that time, the overall trend has been favorable as loans 30 to 59 days past due are at 0.43% for March 2021. And I point out, however, that while they're down, we haven't had delinquency levels this high since 2010, 2011. The disruption's impact, however, on non-accruals initially wasn't as severe as what we saw for delinquencies. For April through July 2020, non-accruals were up only 9 basis points. Then we had a big jump in August and landed above 1% at 1.03% in November. And that's been followed by declines until this month, when the non-accrual rate increased from 0.93 to 0.95. And again, I'll make a comment about that a little later, but it actually is up. So we're going to take a more detailed look at both of these measures on the next couple of charts. So I'd mentioned in the introduction that we collect data on a monthly basis. With this chart, we've plotted the short-term delinquency percentage for each month since March 2020. And I've got a couple observations to make here. First of all, you can see by the trend line, the dotted line, a continual improvement. As we pointed out on the previous page, we had a service high of 1.33% in April of 2020. But since then, the overall direction, at least on the average, has been favorable. Again, some fluctuation, but basically trending down. Second, it's easy to see how this measure fluctuates, a lot of peaks and valleys. And when we took a harder look at these, we found the valleys were quarter end months. And our RAS user at Commerce Bank, Brad Cunningham, speculated that perhaps RMs or credit risk managers were more aggressive with collection efforts to show better quarter end results. And that theory held up well throughout 2020. But as you can see, for March 2021, which is a quarter end month, that's actually above what we saw in February 2021. So it's 0.43 versus 0.39. So we'll have to continue to track this and see if the pattern will hold. The pattern that was good throughout 2020 holds into 2021 beyond this first quarter. If not, I'll have to get Brad to opine on what's going on. So while the overall trend in delinquencies over the past 12 months has been favorable, we're seeing an uptick in short-term delinquencies since December of 2020. The 30 to 59 days past due has climbed from 0.27, now at 0.43. So we thought we'd take a look at what happened over that time period. So basically what we're comparing here is delinquencies at the end of the fourth quarter, 2020, versus delinquencies at the end of the first quarter, 2021. 2020 in the blue, 2021 in the red. There are a couple sectors that had significant jumps in their delinquency levels. Most notable is on the right side of this chart. It's 71, arts, entertainment, and recreation. And the subsectors within that saw big jumps are sports teams and museums. We're also seeing jumps for the following industries and subsectors. Starting on the left, 22 utilities, and that's electric generation subsector. 23 construction, specialty trade and commercial builders. And then all the way over to the right, administrative, support and waste management. And within that, it's armored car service. And a couple of sectors have improved significantly. Right in the middle of the chart, you see the two sectors for transportation. 48 transportation has gone from 0.94 to 0.15%. And 49 went from 0.82 to actually 0. And within 48, the biggest drop in past dues was for the urban transit subsector. And for 49, the biggest drop was for refrigerated warehouses. And we also saw a nice size drop for 21, support for oil and gas. Here's another set of details for short-term past dues, this time by region. And a quick note, in C&I, different from CRE, location is based on the borrower. And what we found is that 5 of the 7 regions have higher past due levels now versus the end of 2020. And the West and the Western Midwest delinquency rates are higher than any other region. The levels for the Eastern Midwest, the Mid-Atlantic, and the Northeast more than doubled. And the only region with a significant decrease was the Southwest. And if you remember from the previous slide, we saw a drop in oil and gas, which is where most of the Southwest loans are located. Now we're going to focus on the change in non-accruals for the first quarter of 2021 versus the fourth quarter of 2020. And we haven't had much movement with non-accruals, 4Q versus 1Q, 0.95 versus 0.98. So you're not going to see much movement here, just as opposed to what we just saw for the short-term delinquencies. Last quarter, we had 4 sectors, and that would be in the blue, that had non-accrual percentage north of 2%. For 21, mining, oil and gas, 71, arts and entertainment, and 72, accommodation, March non-accrual level inched up. But for 45, retail, the other sector that had been above 2%, the non-accrual rate dropped from 2.28 to 1.99, due primarily to big improvements for florists and used merchandise stores. So here we're looking at the percent non-accrual for the 7 regions, fourth quarter versus first quarter. Pardon me. And the results here are about as mixed as you can get. 3 regions are up, 3 regions have improved, and 1 region is about the same. The biggest overall change was a 27 basis point movement towards the better for the South. The Western Midwest had a 22 basis point improvement and is now the best performing region when being measured by non-accruals. But if you remember from our delinquencies, it's the worst, next to worst performing region. So I wanted to take a look at performance by loan size. And here I'm using a new measure, or a measure we actually haven't used in a while, called the performance indicator, or PI. The performance indicator is the sum of the percent past due greater than 30 days and the percent non-accruing. So all loans that are not performing as contractually agreed after 30 days. And we arbitrarily went back 3 years for this comparison, just to get to a point post-energy crisis and pre-COVID crisis, a more stable point in the credit cycle. That's the blue bars, March of 2018. And the red bars are March of 2021. So in 2018, smaller loans did not perform as well as larger loans or participation. But we're seeing a different picture for March 2021. Large loans, those greater than 5 million, are still doing well, but syndications and the medium-sized loans, 1 to 5 million, have experienced large jumps in their PI, while loans less than 1 million actually improved a fraction from a PI of 161 to 1.60. And we believe the PPP program has benefited the small business sector and kept performance at acceptable levels. I also wanted to mention that most of the jump in syndications is related to increases for utilities, investment funds, waste management, and spectator sports. Now we'll switch to credit quality, loan quality, and we're looking at the trend in percent criticized, this time for C&I. And just to reiterate, when a bank joins RAS, we map their borrower ratings to the RMA 10-point scale. That scale has 1 through 6 as pass, and 7 through 10 is criticized, with 7 special mention, 8 substandard, 9 doubtful, and 10 loss. And usually this chart mimics the performance trend chart, especially the percent non-accruing portion of the performance trend. And for March 2021, we saw a slight uptick in non-accruals. And for March 2021, we're seeing a slight uptick in the overall criticized rate as shown here. The March 2021 percent criticized is 8.48%. February was 7.96%. Now, most of that 52 basis point jump is related to an increase in the percentage tagged as special mention, the blue bar. And I'm a little surprised given this increase, given all the optimism that seems to have been generated by the vaccinations moving into full gear, and the belief that the second half of 2021 will see people emerging from their homes to eat out, go to movies, baseball games, etc., and spend money. If you think the special mention is actually a forecast, I would have thought this number would have started to drop. So let's take a look at what happened to percent criticized at the industry sector level. So 19 of the 24 sectors here had an increase March over February. Most of those increases were rather small, but a few were substantial. The largest in terms of absolute change was for 45 retail, increasing to 14.04% from 10.02%. 49 transportation increased to 515 from 307, and 11 ag on the far left is up to just shy of 12% from 10.5%. The biggest decline, however, was for 21 mining, oil, and gas, down to 14.9% from 18.6%. The drop in criticized occurred even though the non-accrual rate increased for mining, oil, and gas, which is why I said earlier on that the percent criticized usually mimics non-accruals. Obviously, there are some exceptions. So this is a little different chart, and 2 quick notes on this chart. The banks presented on this page, this slide, the banks at the bottom, may or may not be RAS banks, just to put that out there. Secondly, the reserves that are mentioned here, the reserve-based numbers, include consumer, mortgage, commercial loans, etc. RAS is C&I and CRE only, so those 2 disclaimers. And what we have here in the blue is the 8-quarter high of the percent reserves. That's in the blue. And then the actual reserve percent as of March 2021. And the level of reserves for every bank on this chart are lower than their last 8-quarter high. Today, we saw non-accruals were flat, but delinquencies and criticized loans were up. So that leads to the question that we've discussed. Are reserves being released too early, or were reserves too high to begin with? And we can talk about that later on. Here's another repeat from what we did with the CRE data. This again is the design chart and combines non-accruals and criticized, but still accruing. Again, it gives you a total view of industries that not only have issues currently, but are also projected to have issues. And on the left is the chart from February. On the right is the chart from March. And last month, if you scan that real quickly, you see we had 6 sectors that were above 10%. Going over to the right for March, the trouble index, as I call it, for 53 real estate has increased to 10.49%. And now we have 7 sectors above 10%. Including real estate, 4 sectors saw an increase in this index: 11 ag, 45 retail, 53 real estate, and 72 accommodation. In the past 2 months, we've explored each one of the sectors or a sector that's been above 10% on the trouble index. And this month, we're going to take a little detailed look at 48 transportation at the 3-digit NAICS level or subsector level, as I call it. The results provide another good example of how the pandemic's disruption impact was or is limited in scope. The trouble index for 483 water and the trouble index for 481 air are about 3 times the index for the next highest subsector, which is 485 passenger. And it's also interesting to compare the pieces for these subsectors. And for example, let's compare 483 water versus 485 passenger. Passenger's non-accrual level, which is the red, is twice of what we're seeing for 483. And the yellow, the classifieds, are close. But the reason 483's index is so much higher is the special mention level, which is at 34% for water versus 4% for passenger. So clearly the outlook for water transportation, which in this case is cruise lines, is not as favorable as what we're seeing for intercity and intracity buses. Now, before we jump into loans, we wanted to launch another poll question. So this time, this is looking at your sales activity, and we would like to know how you best characterize new commercial loan sales activity at your bank relative to 6 months ago. So that's how you're doing today versus where you were 6 months ago. And is it strong, up 10% or more, modest in the low to mid single digits, or weak, basically unchanged to down? And we'll give you 15, 20 seconds to fill this out. Maybe another 5, 10 seconds. Okay, close the poll. And you can see right in the middle, modest low to single mid digits. Okay. So let's take a look at what we're seeing in RAS. So this is a quarter versus quarter comparison of outstandings for every bank in RAS. This is for C&I, same as what we did for CRE. And we're showing the highest bank's growth rate at the top of the tail, the bank with the lowest growth rate at the bottom of the tail, and in between the average. And again, we had calculated for this, the median as well. And again, there was not much of a difference between the median and the average, so we went with the average. And this does include, by the way, PPP loans. If we had not done that, there wouldn't have been anything north of the 0% line. So after 2 quarters where the average was negative, the June to September and September to 2020, we're slightly above 0 for 1Q21 versus 4Q20. And maybe a sign of the optimism that we're hearing for the second half of 2021. And sort of in line with what the poll just said. So we know there hasn't been much growth, but we wanted to see what has changed over the past year. And here we're looking at March 20 versus March 21. And the increase or decrease is calculated by the following: March minus March 21 minus March 20 divided by March 20, just to give you an idea of how we did this. And in this time period, outstandings for 23 construction have increased over 46%. Only 8 other sectors had an increase, with the highest being 72 accommodations at 20%, which I find very surprising given the problems that we've had with both lodging and restaurants. 54 professional was up 18%, and 81 other services was up 17%. 15 sectors had a decline in outstandings, and those are being led by 45 retail, down 30%, 21 mining, oil, and gas, down 29%, and 33 manufacturing, this being metals and machinery, down just about 20%. So along with the change in outstandings, we wanted to look at line utilization. The chart on the left shows utilization for bilateral loans. And by that, we mean bank direct to business, bank direct to borrowers, and it's by deal size. The chart on the right shows utilization for participations and syndications. And those are where your bank has bought into a facility made by another bank. And note that this excludes PPP loans. And even without PPP loans, utilization for every size segment on both charts was up starting in March 2020 versus December of 19. But from then on, utilization has declined for every size segment. And as of March 2021, you see it's actually below December of 2019. So this basically mirrors what we saw on the other page. And you can see there's some dramatic decreases in utilization, particularly for the larger loans. So that's it for March 2020. And there was a suggestion in the response to the February 2021 survey that we switch from a table to a narrative. So here's the narrative, and we'll see if you like this. So first off, March versus February, we saw a lot of changes for the most important data points. But to be honest, overall, most of those changes were very minor or insignificant. 118 versus 120, 93 versus 95, just a lot of noise, as Stephen and I had talked, not much direction. The second one is despite the favorable economic forecast for the second half of 2021, and we had just talked about this prior, the GDP came in at 6 point something for the first quarter, 6.4, I think. It had been 4% for the fourth quarter. The non-accrual rate still remains at or near pandemic disruption highs. So we've had a couple of good quarters, but the non-accrual rate has not moved. Next, new loan volume is minimal at best, and line utilization is down. And then lastly, the K-shaped recovery that we've talked about is very evident from the March 2021 results, especially for industry sectors such as oil and gas, lodging, retail, accommodation and food services, arts, entertainment, recreation, and transportation. So I thank you for your time, and I'll stick around to answer questions. And Stephen, I'll put it back to you.
Thanks, Tom, and thanks for the summary on that. And continues to amaze me. This was a month full of noise, but every month seems to have a different story. And I'm really looking forward to the next few months as we are starting to see some signs of a recovery and what's that going to mean in terms of flowing through to the data that you look at. So thanks for all that. And I know Jeremy works on this too. So thank you, Jeremy. Okay, so quick reminder, you veterans out there, the Q&A section is a pretty interesting section of the presentation. Be sure to ask your questions. Now is a great time for it. There are a couple that are queued up, and we'll get to all of them, I'm pretty sure, or at least as time allows. And the little Q&A button down below is how you do it, not in the chat. Tom's got a slide here that is something that we've talked about once or twice on previous webinars, and we're excited to announce that we've got new business intelligence capabilities that are part of the risk analysis service. And so it's really great for those of you attending now, and then anybody who's listening asynchronously afterwards. We'd like to invite you to reach out to us if you've got interest, if you find some value in not only the overall metrics that Tom kind of takes us through, but if you're curious about what would it be like to compare your bank with some peer banks or the rest of the market. And that's really, one of the key value propositions of the risk analysis service. So this would be the perfect time for it before we come out with our major announcements, later this spring, early summer, and get you guys queued in, and we can possibly schedule some time for you to take a look at it and answer any questions that you have one-on-one. So I invite you to that. Okay, we can go to the questions portion. I always get this question first, and that's whether the slides would be available. And I just want to remind folks that we have changed it up a little bit in recent months, where we are sending out the packet in advance. And so today, from my email at RMAHQ, so it would be smartin@RMAHQ, about 9:36 this morning, the package went out to you. And so it might be in a public folder or a bulk mail folder on your desktop, and you'll be able to find it. I think most of you have. There were a couple questions that came in that suggested maybe you didn't see it. And if at the end of the day you still didn't get it, maybe it got trapped somewhere else, and you can reach out to me afterwards for that. Okay, let's go to the questions then. And we'll start with a softball, Tom, from Tariq. How many banks are you including in the analysis, and are large banks included?
So there are 15 banks in RAS today. And in terms of large bank, I assume this is large bank versus small banks. There's all sorts of banks sizes in RAS. All of them, though, are say $1 billion or more in commercial loan outstandings, up to larger banks. But it's a very broad mix, I would say. It is not a strictly large bank portfolio.
Yep. Good. Okay, next question is, why is there a stark difference in the non-accruing loans for CRE lodging in the East versus South and the West? Similarly, for special mention loans, could it be related to the respective economies or differences in the deferral programs from the banks?
So I guess you would say it's related to the economies, and it's related, I think, more towards the type of hotels that are in these various regions. For instance, the East, when we go down a little bit from the region to the individual state, you see a lot of large delinquencies in New York and Massachusetts. And pardon me, those would be hotels basically that are in New York City and in the Boston area. And if you remember, Stephen and I were talking about this just before, the RMA annual conference last year was supposed to have been held in Boston. Obviously, that was canceled. I don't know how many conventions were canceled in these large cities, how much travel in the large cities was reduced. And so that's why we're seeing it in the East. In the South outside of Florida basically did okay. Florida was not doing well, primarily because of Disney and Universal Studios. People weren't allowed to go there. Similar story in the West with San Francisco and LA. A lot of convention traffic in San Francisco was halted, and therefore a lot of those type of hotels that cater towards the convention traffic were having problems.
Thank you, Tom. Yeah, we did pull the plug on in person last fall, but we managed to pull it off virtually, and I know everybody is looking forward to getting back together. So hopefully, in our future, we'll have a chance to go to conferences like the RMA conference. So thanks for that, Tom. I've got one that came through the chat, Tom. In the Midwest, Eastern Midwest rather, we have a lot of auto manufacturing, from OEMs to Tier 1, Tier 2, et cetera. Have you seen any impact yet due to factory shutdowns by Toyota and Honda, Chrysler, Ford, GM, et cetera?
I have not. That's an interesting question. And if whoever, to the best of my knowledge, we've not. Whoever asked this, if you could shoot me an email, I'll do a little bit more digging on this and see if there's anything there. But to the best of my knowledge, we've not seen anything related to that.
Good, thanks for that. And Tom, maybe if it's okay to advance the slide so they can see your email address too.
Okay.
There you go. Thank you. Okay. Here's another one. Can you please elaborate on your comment about the loss reserves from the 10 banks on slide 21? Sure.
So just to restate what was there, we had one column that showed the percentage that the ALLL percent highest in the last 8 quarters. So of the last 8 quarters, what was the highest percent of the loan loss reserves? And then the next column for those 10 banks had what their current rate is. And for every single one of those banks, the current loan loss reserve rate was lower than it's been in the last 8 quarters. And so our comment was, given the fact that we're seeing non-accruals haven't decreased, and that some of the special mention categories actually increased, we were wondering whether these releasing of reserves is too soon, or if the reserves were too high to begin with, when most of these were made back in first quarter of 2020. So it was either one of the two, and that's what we were trying to point out there.
Terrific. Thank you, Tom. Are there any Canadian banks included in the credit benchmarks database? And how about data from Canadian banks on their US loans?
So at this time, there are not any Canadian banks in the survey.
We can change that, people. If you've got some Canadian banks that are attending today, give us a shout and we can get you enrolled in the program. All right. Well, just one last call for questions. This is the best time to ask, although you can always reach out to Tom and Jeremy. They're happy to answer afterwards. But at this point, we don't have any questions queued up. Yeah, and then I've just got a note from somebody that said there's a Canada chapter RMA presentation on May 20th. I believe, Tom, that you guys will be giving a more detailed look for that Canadian chapter.
Right.
All right, terrific. Well, then I think we've probably done it here, team. I do want to ask again, as I always do, if you can take just a minute or two to share your experience with our webinar. As you heard, Tom, we read through these things and we try to adjust the presentation to your suggestions and your questions. The link is in your chat on the right-hand side, and it shouldn't take you more than a minute or two to answer that. And it is very valuable for us to make this better. So with that, there's no more open questions. I want to thank our panel, Tom and Jeremy, for all the prep that goes into this, and also thank all the people that to make time to attend this. A lot of veterans that come back. I know you have competing possibilities for your information, and we really welcome you coming back, and we are appreciative of that. And with that, I'll close it off and wish you a good day.
Thank you.